Hi, it's Dre Griggs with Obsidian Wisdom. Today we explore dividend investing, tax implications, and setting your financial goals. So in today's video, we're going to answer 5 questions again as we continue in the series. This is our third in the 5-part series on dividend investing. Today we'll answer what are the tax implications of dividends, how much money do I need to live off of dividends, what is dividend growth investing, what happens to dividends during market downturns, and what's the difference between individual dividend stocks and ETFs. Let's start with the tax implications of dividends, and I will be sharing the chart so that you can see the numbers as I go through them, but it's important to start with the fact that there are basically 2 ways that your dividends are going to be taxed. They're going to be taxed as ordinary dividends, which will be taxed at whatever your normal tax rate is, which currently is capped at 37%. The second way your dividend income can be taxed is a qualified dividend. The good news is, as I go through this list, the majority of American companies will qualify as a qualified dividend. So normally you have to be a U.S. or qualifying foreign company. And so as you can see, if you're a United States incorporated company, then you're already a U.S. company. You have that box checked off. If we're talking about a qualified foreign company, for the most part, they normally have to just accept the U.S. tax treaty, where they take that income and they tax it in a way that we ask them to. Or in many ways, you could just find a foreign company that's listed on the S&P 500 or one of the U.S. stock exchanges. Because to be listed on that, most of these companies will have to check off that box anyways, because of the way their income is treated and it's exchanged throughout the United States. The second thing that you need to look at to see if you have a qualified dividend and the more favorable tax rate is your holding period. You would have needed to hold the stock for more than 60 days during the 121-day period surrounding the ex-dividend date. And for those that aren't as familiar with the term ex-dividend date, all the ex-dividend date is the first day that the stock traded without a dividend. And how we come to that 121-day period, we're basically saying that you would have needed to have held that stock 60 days before the dividend, the day of the dividend, and 60 days after the dividend. And if you would have held it for the 121-day period, then you have checked off the second box of having a qualified dividend. Now, for those of you that have a preferred stock, and again, all a preferred stock means is that you have preferential treatment when the dividend is announced and when a dividend is paid. That if we don't pay one, you don't get one. But if we do pay one, you are first in line. You have a preferred position. Sometimes if you have a preferred stock, it's not 60 days, but 90 days. So instead of it being 121 days, now it's 181 days. You have 90 days before the ex-dividend date, you have the dividend date, and then you have the 90 days after the dividend date. And if you check off those 2 boxes, then you're still in the running to have a much more preferential tax treatment of your dividend income. The third and final checklist, of course, the only way that Uncle Sam knows how to do it is he would just say, it's just simply if I disqualify you. So if you're not on the disqualified list, it's a U.S. company or at least a foreign company that accepts the U.S. tax treaty and you have the holding period, then you're in the clear unless you're listed on the disqualified list. And now you're probably saying, well, Dre, what type of companies would be listed on this disqualified list? And the type of dividend income that would be considered disqualified would be REITs, real estate investment trust, it would be master limited partnerships, MLP, and tax-exempt organizations. Now, there are also special rules that apply for dividend income that's tied to a money market account or a mutual fund. But those are kind of case by case, so you do have to look at each individual case. But ideally, if you check off these 3 boxes, then your income is going to be taxed at the much more favorable capital gains tax rate, which caps at 20%. And as you can tell, that's almost half of what your normal income is taxed at. I'll share a chart with you, but basically you can see that you'll be taxed on your capital gains at 0%. For those that are generally taxed within the 10 to 12% brackets. Most middle-class taxpayers are normally going to be around the 22, 24% tax bracket. You're going to have your capital gains tax at 15%. And then if you're in the high income tax bracket where you're going to be in that 30 and above, you most likely will find yourself with a 20% capital gains tax rate. So you can see that you're saving a decent amount on your taxable income, which is the goal in retirement, to put as much money as we can in your pocket for your retirement, the money that you've been investing so that you can buy all of your freedom and enjoy yourself in retirement. Now, before anyone comments that I want to make sure everybody's paying their fair share, I do think it's important to recognize that we have an incentive-based tax structure. And all that means is that the government gives us ideas of where it wants us to invest and improve the country. And if we do that, they then take less in taxes from us. Now, it doesn't mean that it's perfect. It doesn't mean that it's always the best option, but it does mean that if something is aligned with your morals and your values, and you're okay helping the government achieve that, then I think you should be okay accepting the government's appreciation, which is being taxed at a lower tax rate. At the end of the day, the government wants you to invest in businesses so that we can create jobs, so that people can have money and pay taxes all around. That means that the government says, as long as you're in this for the long haul, then how the government makes sure we're in it for the long haul? Well, it does things by making sure you have a holding period. It does things by making sure you're investing in American companies. If you're doing these things and you pay a lower amount in taxes, I think that's a great thing, and it's better for the country as a whole. Question number 2 is, how much money do I need to live off of dividends? This is naturally going to be the question all of us have. All right, dividends sound great. I get money back, yada, yada, yada. How much do I need? How much is it going to cost me? What's the bottom line? The reality is it depends. It depends on what your dividend yield is. The higher the yield, the less money that you need. And that's part of the reason why it was so important in the last video to discuss not falling into a dividend trap. Because in many of our minds, if our yield is higher, then I need less money. For example, if I wanted $40,000 a year, then if I had a 10% yield, to keep the math easy for me, that means I only need $400,000, which is pretty nice. But if the yield was 4%, which as we mentioned is a lot more common than 10%, well, now I need $1 million. I need $1 million invested if my yield is 4%. I only need $400,000 invested if my yield is 10%, which is why for a lot of people, you sit there and say, if that's the case, I'm just going to find 10% of higher yields. So that way I have to save a third of the money, which will be fine. But the issue, as we mentioned in the previous videos, is the dividend yield doesn't tell us enough about the company. We should not just go in and set our filter on 10% plus dividend yields and then buy all the stocks. Because the dividend yield is just taking the dividend dividing by the stock price, that literally means that the stock could have collapsed yesterday. And because it collapsed, the stock price went down a lot, which means their $4 dividend is now a higher percent of the stock's value. But is that a stock that we should spend money and purchase? And I think most of us will say, well, no, of course not. It just literally collapsed yesterday. So that's why the dividend yield is not the only metric. But as far as answering the question, how much do you need? Well, if you have a 2% yield, then that means you would need $2 million. If you have a 4% yield, then that means you would need $1 million. If you have a 10% yield, then you would only need $400,000. The amount that we need is determined by what our dividend yields us, what it gives us every single year. Now, of course, we can always talk about the idea of dipping into my dividends and selling the stocks to generate the excess income. But if the goal is to live solely off of dividends, then what the yield averages for my stock determines how much money I need to have inside of my portfolio. That leads us nicely into question number 3, which is, what is dividend growth investing? The idea of dividend growth investing is I'm going to find dividends to invest in, but these dividends should be increasing every single year. And that helps you in 2 ways. So we just talked about the idea of dividend yield, and that tells me how much I'm receiving. But because that's not the whole picture, another nice metric that we talked about is I could be focusing on how many years they paid this dividend in a row. And if we're focusing on companies that are paying their dividends, then we can level up by saying I'm focused on companies paying the dividend and their dividend is increasing. So if I'm increasing my dividend every single year over a span of 10, 20, 30 years, that means that the amount of income I'm receiving is actually keeping up with inflation, which you and I know is pretty important when it comes to retirement planning. I don't want to just have an income that is $100,000 today. I need to make sure that my income is increasing by inflation every single year so I can maintain my overall lifestyle. And this extra benefit that we receive in retirement, where income is increased with inflation, we receive that same benefit throughout our overall investment cycle, where I'm able to put the money, not only that I'm investing in it, not only the appreciation of the stock, but the income that the stock is creating, investment income or dividend income, that's being reinvested in the stock. And I'll share a graphic with you that shows how dividend growers have outperformed stocks over time. And what you'll see is the purple shows dividend growers and initiators. So these are dividends that are increasing every single year. And then you can see all dividend paying stocks, they're also doing pretty well. And then you can see dividend paying with no change in the dividend. So it's the exact same amount, not keeping up with inflation, non-dividend paying stocks, and dividend cutters or eliminators. People who were paying dividend stocks at one point in time, and then something happened where they had to cut their dividends. You can see that dividend growers and initiators has outperformed the rest of the market in many ways. And if you're able to consistently pay dividends throughout these different crises, we know that we found a really good, stable company to invest in. So sometimes it's not even the idea that, hey, we've been paying a dividend for 20 years and we've been increasing it. Sometimes it's just a tell that I must have found a really good company, that you are a dividend aristocrat, meaning that you've been able to pay your dividend consistently for at least 25 years. which means that you paid your dividend through Y2K and 9/11 and the dot-com bubble and COVID that we just went through, that you did not have to cut your dividend for any of these events. I probably found a really stable and a really solid company. I can look in the details and make sure everything checks out, but the idea that you've been paying a dividend for 25 years and that you've been increasing your dividend, I assume I'm going to look at the dividend payout ratio to make sure that you're not paying higher than 75%. And if you check off these different boxes, I feel pretty good. So Johnson & Johnson was one of those. We know that they performed very well. Now, I mentioned in a previous video, and I'll put a link to it, that healthcare is something that performs very well through a variety of economic climates. Because whether we're in a recession or times of economic growth, I got to see the doctor. That leads us into question number 4. What happens to dividends during a market downturn? Well, the reality is, like most of the things I've been telling you, is it really depends. I always wish I can give you the bumper sticker answer that we see sometimes from these gurus, but the truth is it depends. You know that if you're invested in a sector that performs well in times of a recession, then they're going to continue paying their dividend. If you invest in a dividend that performs well during times of economic growth, then that might mean that they cut their dividend during an economic downturn. It depends what sector that we're in. We know, for example, if you just Google dividend aristocrats, that Procter & Gamble and Johnson & Johnson paid their dividends throughout a variety of economic climates, and they have been doing so for a pretty long time. We would say in that situation, I'm looking pretty good. But if you're talking about 2008's recession and you're in the financial sector, several financial banks cut their dividends because they were the ones that were dealing with the credit crisis and the crunch, different things like that. We know that if you were investing in travel and leisure or airlines or something like that, and then COVID came through and you're not allowed to travel, then they're probably not going to be able to pay out a dividend either. We know that when we talk about the automobile industry, when they were collapsing and the government had to bail them out, the Toxic Asset Relief Fund, TARP, then we know that they had to stop paying their dividends as well. That most of the time when a company has to figure out what to do with their money, they love to share it with their stockholders. But if you have no earnings, then you're probably going to cut the dividends. So the question becomes, will this sector or this company continue to generate earnings in a variety of economic climates, such as a recession and economic downturns? And sometimes we don't know. And we'll close out this discussion with question number 5 of our dividend investing strategies, which is, what's the difference between individual dividend stocks and ETFs? So high level, whether we're investing in individual stocks or ETFs, the main difference is going to be, if I'm investing in an individual stock, I have the ability to make more money or less money. Because I'm choosing the stocks, I'm not now taking in the wins with the losses of a blended and diversified portfolio or ETF. I'm just choosing the winners. And if I choose all winners, I'm going to make more money than someone who's invested in an ETF that has winners and losers. The concern is, and the reason a lot of people do choose ETFs and why I do think that your financial goal decides what your investment strategy is if you're someone who's not interested in checking the stock market on a regular basis, you should probably invest in ETFs. If you're someone whose retirement goals can be funded with a return that an ETF generates, then I would say go ahead and let your goals decide what your investment strategy is. We shouldn't have our pride decide what our investment strategy is. We shouldn't have the coolness of being able to say that I'm choosing stock winners. If you need a 7% return, there's a ton of ETFs that can generate a 7% return. So you should just invest in those and deal with the risk on a smaller level, because we have a blended portfolio where we have winners and losers. Well, they've already chosen the dividend growth stocks and the dividend high yield stocks. They've already blended it together for you. And now you don't have to check it on a regular basis. You just let it kind of sit and ride out. You don't have to think about it at all, whatever your dividend portion of your portfolio is. But recognize that your ETF will not perform better than best case scenario of choosing an individual stock. Think a hedge fund where I'm able to choose 10 phenomenal companies. We crush it. I generate a 30% return, rainbows and Skittles. But at the same time, what if you chose all 10 wrong? For whatever reason, you followed the approach I gave you. We talked about it. You read Bloomberg, you read Morningstar, you felt really good about it. For whatever reason, everybody was wrong and every single stock performed horribly. So now you've actually chosen the 10 worst dividend stocks. Well, in that case, now you would have been better off if you had the blended portfolio, because you were in the industry or the sectors and you had this strategy that would have still performed well as a whole, because right in the stock market, we know historically speaking, it goes up over time. It doesn't mean that everybody goes up. We've had companies that completely disappeared during the time the stock market has historically gone up, which means that if I'm able to mitigate that risk, then I should. But if you're someone that feels confident, comfortable, enjoys reading the financials, learning about the stock market, and you feel like you have a really good investment approach, then sure, put your scorecard together, grade these companies out, and then choose your 10 stocks, and then keep track of those 10 stocks. Keep track of those 20 stocks. Normally, I've seen people get as high as 30. I think you can probably be around 25 and still have a pretty nice diversified portfolio. But keep in mind, if your goal is to have the highest return possible, then you normally have to have fewer choices because you're just choosing the winners. The reality is there's not that many winners. Most of the time when we're building portfolios up to 20 to 30, which is what I generally would recommend for you, we're trying to make sure that we have a portion that performs well in a variety of different economic climates. And that ultimately means that there's probably a proportion that's not performing well during a variety of economic climates too. But because I built this portfolio that generates a certain return, I know, or at least I'm relatively comfortable knowing, that I'm going to hit my mark. I'll have some ups, I'll have some downs, that we know there's some volatility and that there are some overall adjustments in the market as a whole. But I feel really good that I'm going to achieve the goal that I have set for myself. And that feels really good as far as a financial planner's goal, because my goal isn't always to just simply have the most money possible. Now, a lot of the time, the goal is to make sure that everything that you dream of for your retirement is achieved. That if you want to travel, we travel. If you want to hang out with family, we hang out with family. If you want to build a legacy, we build a legacy. If you want to pay for a college for your grandkids, whatever the goals are, I want to be able to put a number on it and achieve every single one of those goals. But we don't just want money for money's sake. That we literally just going to swim in it like Scrooge McDuck, as I often say. I don't feel that that provides as much of a value, because your happiness is not how much money you have. What you're really trying to get, and what we can achieve without having all that money, is you want to have peace of mind and financial stability. For many of us, we don't actually need as much money as we think to achieve that financial stability. We're just so uncertain and so uncomfortable because we don't have a very good idea of how much money that we need, that we ultimately say, how about I just get a whole bunch of money? And then I know no matter what happens that it's almost impossible for me to run out of money. And sometimes that is what we have to do. But I have found that if we know what all the goals are, we know what you need from a financial standpoint, from a dollars and cents perspective, we know what you need from a fulfillment standpoint, a spiritual standpoint, from a family standpoint, from a romantic standpoint, then we can achieve this lifestyle for you. I find that people are very happy, they're very comfortable, they're very confident, and they feel really good about retirement. Which is why sometimes it could be as simple as choosing the Vanguard Dividend Appreciation ETF, that's VIG, or the S&P Dividend ETF, which is the SDY. You can just choose these, kind of set it and forget it, whatever portion of your portfolio is on dividends, have that percentage allocated, and then you can move on to the rest of your portfolio. So hopefully what you found in this video is a very practical approach to dividend investing that can address your financial goals and deal with some of the common concerns that many of us have when it comes to retirement planning and ensuring that we have a predictable income for the rest of our retirement life. And hopefully what you realize, the goal in this video was to give you actionable steps so that you can actually do something where you're not just sitting and talking about it, but you're able to put the plan together to ensure that by the end of this day, if you really wanted to, you can have your plan in place and enact your plan tomorrow. If you have any additional questions about dividend investing, go ahead and leave them in the comments. I'll do my best to answer them for you. I'm so thankful for the time that we have together. I don't take it for granted. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.